Welcome back. And currently at the highest point of the day now, 300 points higher on the Nifty, 1,000, almost 1,000 now on the Sensex. And Venkatesh Balasubramaniam from JM Financial Institutional Securities is joining in to take this conversation forward. Venkatesh, good morning. Thank you for joining in. Just reading your note where you mentioned that the EPS downgrade cycle is still not over, and we have almost recovered around about 3,000 odd points from the lows that we had made during the tariff drama. What do you expect from the first quarter of this financial year? We'll just start reporting numbers in a few days from now. Is this going to be a quarter similar to what the third and fourth quarter have been of the previous financial year, or do we see some green shoots of earnings recovery start to show up now, considering that we'll be having a low base of last year?
Okay. See, our analysis suggests that the earnings, decline cycle has not kind of ended. Even in the month of May, we saw something like around 1.5 to 2% kind of EPS cuts on the Nifty by consensus. As we start first quarter, I wouldn't be very, very optimistic because you will definitely not see great growth from the banks. Banks form a very big chunk of the index. So with the interest rate cuts, you could definitely see a NIM compression in the current quarter. Not that it is not part of consensus expectations. I think most people have already factored that in. We are expecting weaker numbers from even the auto sector. So I don't think it is too early to look for green shoots at this point. This time is our view. And anyway, for the current year, I think consensus expectation and even the JM financial expectation is that EPS growth will be in the low digits kind of low double digit kind of level, maybe 10% to 12% growth for the full year of FY26. So still early times to look for green shoots. We personally believe the second half will be better for EPS growth than the first half.
Okay, H2 for EPS growth will be better than the first half, and you're saying autos is not something exciting, as well as banks. You're not expecting them to do well in Q1, obviously, given so much has happened from their front. Venkatesh, good morning. This is Vinny joining in the conversation as well. But then where do we find value, right? At such a point of time, what should you be looking at in terms from the market point of view? Should it be more large cap? Should it be more mid and small cap? What are you all looking out for?
Okay. Now, there was a brief period, maybe 1.5 months back, where there was a definite trade available, which was large caps were preferable to small caps and mid caps. But we personally believe that opportunity is long gone now after the rally in the large caps. If you look at headline valuations, you will perhaps feel large caps are cheaper. Large caps are trading at maybe 22 times FY26. Mid caps are trading almost like 29 times and small caps are at 25 times. But interestingly, the EPS growth profile, if you look at consensus numbers, are very, very different. So for large cap, expectation is around maybe 10% growth over the next 3 years. For mid caps, the expectation is almost like 20% plus growth over the next 3 years. For small caps, it's 15%. So if you adjust for growth and you look at something like a PEG multiple, you will realize that actually mid caps are much more cheaper than large caps. So this prefer large cap trade is largely over. Incrementally, it is about you should not bother about the market capitalization of the stock. If there is growth visibility, you should go for that stock and not really bother about what is the market capitalization per se. Now, interestingly, we said for the first quarter, banks' numbers might not be that great, but we still would suggest investors that they should be overweight banks because the weaker numbers are largely in consensus expectations. But if you broadly look at across the board, all the sectors in this in India, if you look at the Nifty per se, banks is one sector where valuations are very, very reasonable. Private sector banks are trading at in line with the historical mean. Public sector banks are trading one standard deviation below. Most of the other sectors in India are trading at one standard deviation above mean. So valuations do not make sense. So that is why we have in our model portfolio, we're running almost like 120 bips overweight on banks. Incidentally, we have an overweight even on insurance because insurance valuations have also started looking very reasonable. And even for AMCs, we are running a small overweight. NBFCs and AMCs, we are running a small overweight.
You know, Venkatesh, there has been plenty of chatter regarding the oil prices and all the developments that have happened. Crude almost down now 15% from the peak that it made yesterday. Now, where do your preferences lie within this oil and gas basket? Or are you even preferring this basket to begin with, whether it be the upstream explorers, the ONGCs and the Oil Indias, or the downstream refiners, the oil marketing companies, or even the city gas distribution players or the IGLs and the MGLs?
So we have a complete avoid on oil and gas, but surprisingly, we have an overweight on oil and gas because we have an overweight on Reliance Industries, and we are playing Reliance Industries for the telecom business, not for the oil and gas business. Yes, even in Reliance, we believe petchem margins have kind of bottomed out, but overall, we are not too constructive on oil and gas as a sector. We like Reliance Industries for the telecom business, and for that, because we believe over the next 12 to 18 months, there will be rate hikes in telecom. And beyond that, we also believe that if we see a Geo IPO over the next 12 to 18 months, the sector could re-rate. So we like telecom as a sector, we like Reliance hence, and as a consequence, we can't help it, but we have gone overweight on oil and gas because of the telecom business of Reliance. And we are also positive on Bharti, so we are overweight on the telecom sector as well.
Okay, so telecom is also something that you like. You're more overweight on Reliance's telecom side of the business, but obviously it comes as a parcel. And Bharti Airtel is also what you've mentioned. But Venkatesh, thank you so much for joining in with us this morning on CNBC TV18 and giving us your views in terms of individual stocks, sectors, and what are you watching out for on the fundamental front. So that was Venkatesh joining in with us from JM Financials on his views on the market. But on that note, we're actually going to slip into